There is blind justice, and then there is trading justice, so that you can finally afford to get that laser eye surgery. Not only will people find you more attractive once you ditch those old glasses, you'll be able to see your charts better. That's what we call win-win. Speaking of winning, it's time for a little trading justice. Brought to you by TackleTrading.com.
Welcome out to Tackle Trading's first ever podcast. My name is Matt Justice. My co-host, Tim Justice, the Justice Brothers from Trading Justice. We're here to talk to you guys about what's going on in the marketplace this week, how we see the market going in the future, where we're at, and to make fun of the Fed a little bit, obviously, because that's in our contract. Tim, how you doing today?
Man, I'm doing great. You know, Monday night, 8:30, May 5th, Cinco de Mayo. Can't be better.
Can't be better, huh?
Yeah.
Have you ever heard the May the 4th be with you before? Have you ever heard that in your life?
No, but for some reason I heard it 800 times yesterday.
I have been a Star Wars fan, so have you, our
Yeah.
entire lives, and all of a sudden we have Star Wars Day on May 4th. I've never heard of that. I was so offended all day long on social media. I wanted to throw
Right.
my phone away. I was offended as a Star Wars fan, as a movie buff fan. I was just ridiculously offended. It's the craziest thing. Social media, Facebook should go down in price simply because of what they made me have to go through yesterday. I truly believe that.
I think you have to have that inner filter where you recognize that 800 million people are also saying the same thing, so you know it's not cool. You got to just not do it.
Well, I don't know who the philosopher was, but they said if you ever find yourself constantly agreeing with the masses, you really need to, evaluate where you're at in life. Oh, Facebook, social media, can't stand it. The populace. Anyways, I digest. I'm going to short Facebook tomorrow because of it.
I like it. You know, sometimes I go buy Harley Davidson just to remind myself I'm an American.
Just to make yourself feel like more of a man
Yeah,
than you really are.
It's funny how we have these emotional connections with these companies. Yeah, Harley Davidson, Facebook. I shorted BlackBerry for a long time. It was actually a really good trade, just because I hated BlackBerries and I thought they were just a bad phone.
Well, I mean, it was a bad phone, and I don't know why it was so popular to begin with, but they were being getting killed forever. Another thing, like my wife, her, she's a consumer through and through, correct?
Yeah.
Loves shopping, loves Amazon. Absolutely
Careful.
loves Amazon. Hey, listen, I doubt she'll ever listen to my podcast anyways. I can say whatever I want. But in terms of Amazon, love trading Amazon. It literally makes me feel like I get things for free.
Yeah.
It's just it's an amazing dichotomy. Like, people always ask me whenever I'm given, like, when I'm teaching a class or at a 3-day training and I'm introducing trading to people and whatnot, they always ask me, how do you find a stock to trade? How do you find a stock to trade? And I talk to them about, okay, well, here's how you can scan, here's how you can do this, look at these different fundamental lists, or just talk things about the companies And I always talk about how my wife loves to shop on Amazon, so I trade Amazon.
What you should say is I look at my bank statement and see where my wife's been shopping lately.
Oh, let's see. Marshalls,
Just buy
Amazon.
those companies.
Oh, I'm telling you, Verizon bill, Verizon bill's $300 a month. Do you want to feel like you get a free phone? Go trade Verizon. It's just something that makes me feel a little better about life in general, I should say.
That's a common thing, though. I talk to new traders all the time, and they'll complain that they can't find stocks to trade, and I'm just thinking, well, you got to get better then, because there's a million stocks out there.
Yeah, there's only 15,000 of them. Throw a dart. Seriously. 80%, for 5 years, the market has went nothing but up. It's had its pockets during the summer, of which we'll talk about here in a second. But, 80% of the market is correlated. So if the market's going up, 80% of stocks are going up, and everybody's always like, I can't find a trade. I can't find a trade. I can't find a trade. And it's like, really? Throw a dart. Seriously. Pick one. It's really not that difficult to find a stock to put on a watch list that you can trade over time. The biggest hurdle is just doing it yourself. When a lot of people have never done it before, they get so psyched out over the gravity of the massive market that they just psych themselves out. When the market is actually simple. Mm-hmm. It's buying and selling stock. It's things that we've done literally our entire lives. You just haven't put it into the proper context.
Sure. Yeah, I could go off on that for a while. I mean, sometimes, when I mentor, Matt, you know that I mentor and I work with people one-on-one. I can literally look at their face and watch them try to interpret all of the information on the computer screen.
Mm-hmm.
And I just know it's overwhelming them.
And they start squinting a little harder. And
right.
Their face gets a little closer, and it's just like, it's time to take a break.
Right. You take a break and take a walk, or even something that I've done that's been really successful with people is I'll give them like a 5-step list and say, don't try to do everything at once. Do this thing first and do that thing second, and so on and so forth.
Well, it's an amazing situation in life where we understand that we cannot master something in such a short time period. But if we can't master the art of trading in a $5 trillion worldwide industry daily, if we can't master that in a few days, then we fail as human beings. People need to give themselves a little leeway here. You know, it is a massive market. It's a fantastic market. It's a fun market. We love trading in it, but you got to give yourself a little flexibility and a little time to really learn how to, find a stock, how to trade a stock, how to buy one, where to buy one, where to target, how to short a stock, and then the massive options market out there. But once, it's like riding a bike. The first time you got on a bike, you probably were a little scared. You probably, bumped your knee up a little bit. And what'd your old man do, Tim? The first time you wrecked, what'd your old man do?
Put me right back on a bike.
He probably didn't even say anything. He just put you right on a bike. We didn't even have training wheels. Put you right on a bike, and he made you go wreck. Ride it down the driveway. You remember old driveway, that little steep driveway? Ride that thing, get cooking down, and hit the pavement and crash and burn without a helmet. And you know what? Amazingly, we didn't die, but at the same time, we learned how to ride a bike.
Oh, thinking back, I should be dead by now, but that's neither here nor there.
That's a subject for a completely separate podcast.
I've done so many dumb things in my life.
The child rearing of the Justice Brothers.
Sure.
Oh, wow. Interesting.
Well, I mean, there were 6 of us. We raised each other a lot. It's
true. Well, I mean, 2 hardworking individuals, parents, had small businesses. They owned a construction company. They owned an insurance company, a tax business. Our old man was the commissioner. Mom was doing her things, saving the highways and stuff like that growing up. Our family was very politically active growing up. We learned how to raise ourselves, cook dinner, even if it was just canned chili. And I think that mentality, that do-it-yourself mentality is really helped us out in our trading careers, Tim. To where, when bad things happen, and they happen to all traders, we don't give up. We never give up.
Just deal with them, yeah. I was just going to ask you that. I was going to transition back into our trading conversation. And, how much do you think somebody's background has to do with their success rate?
Well, first of all, I mean, that's a loaded question. But first of all, I think anybody can be successful. I really do. I believe the turtle traders proved that out, bringing people off the street with no financial understanding whatsoever and teaching them how to trade. And just think about the differences in personalities and demographics and, all from different shapes and sizes from all over the globe of people we have taught, right? That have found success. I mean, I'm sure you've been the same, but I've had, the farmers from Texas and the lawyers from New York and the hippies from San Francisco. I've had every single dichotomy, every single demographic, age level, income bracket, professionals, blue collar individual coal miners, right? And they've all found success.
I want to see how far you can run with that stereotype. So you just called all the people from Texas farmers, all the people from San Francisco hippies, and all the people from New York lawyers.
What percentage of the human population did I just offend?
I think probably 60%.
60%. I was aiming at 75.
Yeah, you didn't hit it.
So I got to try a little harder. Obviously, I was not trying to paint a wide brush with everybody, but I'm just saying that those were my 3 last mentor students, right? The guy with the tie-dye T-shirt on, long hair, looked like the scientist from Back to the Future. He was from San Francisco.
Oh, I love it.
the cowboy from Texas, and I just mentored a lawyer from New York. So
Gotcha. Context.
yes,
Okay,
put
I'm
it
okay
into the
with.
proper context. I'm
All right.
accepting of all people, including dogs and cats, as obviously. But yeah, to answer your question, I think anybody can be successful, but there are a certain personality that I think has the greatest probability of success in trading, and that is people who are very resilient. The entrepreneurial spirit, people who are self-made individuals, people with the type of mindset that failure is good, because
Yeah.
if you're failing at something, it means you're doing something. Too many times in life, people just think it should be given to them. And honestly, one of the things that frustrates me in my travels, teaching people in this amazing concept we call trading, is there's a degree of complacency in American society right now. And it's not everywhere. It's not everywhere, but it is prevalent in many aspects of our society. And that complacency, that will never lead to success. If you give your authority away to somebody else, there's somebody else out there that knows how to take everything from you, and they will. It might not happen today or tomorrow, but it might happen over time. It might happen over devaluation. It might happen over the inflation of goods. It might happen over, a next bear market, or whatever the case might be. The most important thing you can do is take control for yourself. Stop being complacent. Stop procrastinating, because that never works out. It didn't work out in college for me, and it certainly has not worked out in life. You have to take the bull by the horns, and you have to learn how to fail. I was asked by a coworker. I was out in an event in Dallas this past week, and I was working with this individual by the name of Jabon. And Jabon's been trading for a while, and awesome guy. Love Jabon. We're going to have him on the podcast eventually, because he is just awesome. But he was talking to me. He goes, "Hey, Matt, how long does it take you to find success?" And I said, "You got to learn to fail a lot before you understand success." And it's the truth. I mean, the reality is, if you have success in 3 months in the market, the next 3 months you might give it back because the market cycles on you. You have to learn how to fail to succeed. So to answer your question, I think it's the mentality of individuals who will never give up, just will refuse to give up.
And I'm going to tell you, this is going to sound strange to new traders, but you'll know exactly what I'm talking about. One of the worst things that can happen to a brand new trader is that they win every
initial
time.
Initial success is horrific.
The head blows up. They think they're a rock star, and eventually they're going to hit the wall. And that doesn't mean we don't want people to succeed, but you have to understand how the market works. I mean, sometimes you win, sometimes you lose. It's the nature of the beast. They call it a probability system for a reason.
No doubt. Well, just last week, the week before last week, so 2 weeks ago, had a killer week in the market. I could not do anything wrong in the market. I was short heavy Netflix. My credit spreads were working. My earnings positions were working. It was awesome. And the account's going up and everything's happy. I'm patting myself on the back. And you know what? On Tuesday of last week, the market's breaking down. CMG breaks down. Google breaks down. Netflix breaks down again. IWM, the Russell breaks down. Guess what I do? I went short, heavier than I typically do. And literally, I'm not kidding. It might have been the worst timing I've ever had in my life. Right. Within 5 minutes of me taking every one of those positions, guess what the market did? Responded, closed up like 1.5% from the low. From 5 minutes within. It's like I was looking at the screen going, I don't even know what to do. I mean, I had deer in the headlights look going, is the trading gods going against me? What did I do to offend the gods? And probably it was probably just the trading gods saying, Matt, your success last week had nothing to do with you, so give us credit.
Right. And it's a new day. You can't rely on what you did last week. You got to
approach everything new. You got to approach everything new. You reallocate. You load up that 6-shooter again. Speaking of 6-shooters, the Fed doesn't have one. But you got to reload and you got to keep firing. Go ahead.
Explain this to me, Matt. Last Wednesday, the Fed came out and said that instead of $55 billion, we're only going to print $45 billion, and the market didn't do anything.
Well, first and foremost, I just want to thank the Fed and Janet Yellen specifically for lowering it to $45 billion instead of $55 billion. It's very kind and generous of them only to give Wall Street $45 billion a month instead of $55. But when you add up the gravity, they have given Wall Street $4.3 trillion.
Is that with a T?
Did you say T with the trill? Think about the zeros behind that number. And real quick, and I'm not going to get on a soapbox on the Fed too much, but let me just say this. When the Fed started their quantitative easing program, it was designed to make everybody get access to credit. Wall Street, small business owners, consumers, you and I, they were trying to lower the interest rate so that they could help out the economy as a whole. What they failed to realize, and this is on the Fed, and you would think really smart people would know this, right? That's what you would think. What they failed to realize is that coming out of the subprime market, banks were not loaning to consumers who couldn't pay their bills. The banks were not, in the subprime market, the bubble market, people could walk in off the street naked without taking a shower for the last week, have no money down, and get a house out of that.
I don't know if I've ever told you this story. I've lived in only one house. I've only owned one house, and it's here in Utah. And when I went and got my loan, Matt, I walked into this guy's office who's on the board of realtors, I think, or actually lenders or whatever it is for the state of Utah. And he just said to me, Tim, I'm pretty busy. Can you afford the house? I said, yeah, I can afford the house. He says, okay, I'll have my son drop the paperwork. Come back in next week. And that was it. That was customary. I mean, people literally walking with credit scores of 560, 580, 600, no money down, and getting these atrocious loans with horrible interest rates. When the market crashes, all of a sudden they can't pay back the massive interest rate loans, so they give their house back to the bank through foreclosures and whatnot. And now the Fed comes out with this economic monetary policy called credit easing at the first. They later changed it to quantitative easing to make sure everybody could go out and get a loan, but banks who were over leveraged up into the hill and at massive amounts of risk by themselves increased or decreased the ability of consumers to get credit. So when the Fed kept lowering interest rates in 2008 and when they started quantitative easing in 2009, what happened was consumers were scared out of their mind. They weren't going to get a loan. There was no demand out there, and the banks, for those that wanted a loan, wouldn't loan them out. So here we have this almighty federal central bank, right? Who is supposedly part of the smartest people in American and world society. These are Harvard-educated individuals, and they could not understand simple supply and demand principles because there was no demand by consumers to go out there and borrow money. So as the Fed lowered money and as the Fed kept printing money, where did that $4.3 trillion go? This was the absolute biggest failure of the Fed. The $4.3 trillion went straight to Wall Street because it was Wall Street who was loaning out. It was Wall Street who was borrowing all of the money to do their stock buyback programs, to do their mergers and acquisitions. $4.3 trillion. It is the absolute biggest bailout in American history. $4.3 trillion so far. So when I say Federal Central Bank, Janet Yellen, thank you very much for only giving Wall Street $45 billion this month. So you said something, probably the one thing you said there that struck me the most is when you said that they changed the name of the program from credit easing to quantitative easing.
Well, think about it. It was originally called credit easing, okay? But when you say the word credit easing, is that fairly easy to understand what that is?
too many people will get it.
Okay, even society gets it, right?
Yeah,
Even
right.
the layman gets it. The coal miner gets it.
That's great.
Everybody gets it. So they later changed the name to quantitative easing. And quantitative, when you say the word quantitative, people literally just start shutting down. They tune you out. They're like, seriously, did you just say quanta something?
Right. It's
I'm
like
done.
an
I'm done.
Orwellian novel.
Go give me my beer. I want to go
Right.
have a beer.
Exactly.
You said quantitative. Does that come with a shot of tequila?
Well, it's funny. I think markets do that, though. I think politicians do that, too. They drum up complicated $25 words to make it sound different than what it actually is, when it probably could be explained in a very simple way.
Lawyers, man. They're all lawyers.
Yeah.
They make it sound as complicated as possible so nobody understands. And what happens, it's the same thing that happens with our economic reporting system.
Yeah.
When you have a difficult economic reporting system that is hard to understand, nobody questions it. Like, for example, when you get the unemployment report last week, it was reported last Friday. The unemployment report came out at 6.3%. It was expected to come in at 6.6%. The previous month was 6.7%. Okay, Now what that unemployment number does not represent is people who are no longer receiving job benefits, which the amount of people who are priced out of the market from a technology perspective that is no longer receiving job benefits is more than the people that is receiving job benefits. So let me ask you, why is it that our reporting system does not include the people that are no longer seeking a job? They're still unemployed, right? Would you agree with that? They're still employed? Why is it that we do not include them? Why is it that our CPI report, which is the Consumer Price Index report, why does it not include the rising cost of food and energy? When the Federal Central Bank comes out and says we're deflating, they're talking about everything out there, right? But what they're not including in that is the biggest cost to consumers. The biggest cost to a consumer is not technology on a yearly basis. In fact, I was talking to about 10 students just today, and I said, how often do you guys buy a laptop computer? And one said every 8 years, which I thought was quite ridiculous, but it's
crazy.
8 years, right? That's not me. But let's just say it's every year, right? You buy a new technology every year. Well, what's a bigger increase in cost or a decrease in cost? Is it the decrease in technology that we pay on a yearly basis, or is it your food bill every other week? Or is it your gas bill every week? When you're talking about the rising cost of food since the year 2000, January of 2000, has increased 270% based on the food price index. When you're talking about a barrel of oil, in 2000, a barrel of oil was $15, T. Today, it's over $100. That's a 660% increase in cost. Okay, so why is it that our reporting system doesn't include the people who are no longer seeking jobs? Why does it no longer include the rising cost of food and energy? Why does the Federal Central Bank change the name credit easing to quantitative easing? Why do you think that's the case?
These sound like rhetorical questions.
Maybe. A little bit.
I know your lawyers speak. I know how you work.
Leading questions, buddy.
Right?
I don't admit that I went to law school very often.
I think the obvious answers are right there. They set this system up to make it complicated so the average person thinks that things are better than they are. And they try to deceive people, and that's what it is. And it's sad. But it also is, I'm not the kind of person who believes in making excuses. So it's like I will sit around and bitch about the government from now until the end of time, until like where we grew up, until the cows come home.
Yeah.
But at the end of the day, what you said earlier during our little podcast here was interesting. You got to wake up every day as an entrepreneur and not worry about what's going wrong. You got to figure out a way to make your time right.
Yeah,
you got to figure out a way to make yourself productive in that day. The reason they do it, Matt, is because they're trying to pull the wool over people's eyes because they don't want to get voted out of office. That's what it is.
When I look at it, was it Marx who said opium for the masses? Was that Marxian?
Yeah.
That's kind of how I see it. It's a drug for the masses. If the masses see an inflation at 2%, that's expected. They don't question it. If the masses see unemployment at 6.3%, that's not expected. It's still high, but at the same time, they don't question it. If the masses hear words like quantitative easing, they don't even look into it to see that, the market has been, Wall Street has been given $4.3 trillion. They don't question it. And when consumers don't have a reason to question, they are complacent, they do nothing, they go along with the status quo, politicians are happy, central bankers are drinking their, high-end, whatever it is, and Wall Street's happy, everybody's happy, even though consumer society in America is literally getting screwed over, getting everything taken from them without them even knowing it through a devaluation of the U.S. dollar that's occurred by 38% against every major currency since 2000 because of some of these monetary policy principles. They don't question it. But when they start to question it, T, is when, their 401k isn't performing. You know what, guys? Their 401k never performs. Aggressive mutual funds last year went up about 22%. Conservative funds last year went up about 8 to 10%. Bond-related mutual funds went up a rock solid 0 last year. And people, I've asked probably 5,000 people this question this year. Is a 10% growth last year good? You know what they all say? Yeah, that's fantastic. That's amazing. Really? The market went up over 30% last year. You went up 10. You got to question that, but they don't because they don't have a reason, or they're financially illiterate, or whatever the case might be. And I don't even blame them anymore, because we don't teach it anywhere. It's done
honestly,
there.
You're feeling too bad for them. They're watching the Kardashians, Matt.
Nobody watches the Kardashians.
Well, the point is a lot of they don't care. That's the whole point. Government's
they
got
deserve
to figure
it.
it out.
Then they deserve it.
Yeah,
they deserve losing money. No, if they're watching the Kardashians, they deserve to get everything taken from them. That's on them.
Well, and I guess the reason I bring that up is the people I want to spend my time with are those who want to know this stuff and get better and learn it and understand it. I'm not going to sit and cry and whine over somebody who doesn't even think about it or care, just wants to crack another beer and hang out. I want to spend my time with somebody who actually knows there's a problem and they want to figure it out and get better with and understand stuff better and be more productive. Because I think the entrepreneur mindset is something that I've just started to really understand for the first time in my life the last few years. It's that you got to wake up every day and try to do something awesome. Every day, and you're looking for opportunities and you're looking for things that you can do and ways to make money and all that. And it's not necessarily just about money, because I think if you're productive and you move forward, you don't have to be a victim to all this stuff. I mean, you don't have to be tied into whatever the Fed decides. I mean, it is garbage. We know it's garbage, but it's more about mindset to me lately.
Well,
and
in looking at that, whether you like quantitative easing or not, whether you like politicians or not, whatever your personal belief system is, in the financial markets, it doesn't matter.
No. What's the saying? What's the old saying?
Trade what you see. Trade what you see. It's and it's an interesting scenario because a lot of people come in there with their personal belief system, and they get it handed to them. I had this individual I knew. I didn't teach him. It was a guy by the name of Steve, and somebody gave him my contact information. That's about a year and a half ago, and just out of some generosity, I decided to call him up and talk to him about it. At the end of the subprime market crash, I'm talking the end, not the beginning. This summer 2009. Steve had $4.5 million. When I talked to him in late 2012, Steve had $450,000, despite the market going up. And the reason Steve had $450,000 was because Steve was a radical Republican who hated Obama. Literally, I hated Obama. Okay, he hung up on me when I said I voted for Obama. He hated Obama. The world's problems was due to Obama being the president of the United States. And when I told him, Steve, the president of the United States has very little to do with current market action. He just didn't get it. He just didn't get it. Radical Republican, shorting the market, buying put options on the spiders. And what he would do, and he was trading futures contracts on the E-mini. What he would do was he would always buy short-term. The market would always go up, 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 up. And $4 million later, he's given it to the market because he is so emotionally embedded in being this radical right-wing individual. And by the way, radical left-wing individuals are just as bad. But a radical right-wing individual thinking the market's going to go down because, we have this individual who is president that he doesn't think should be in office. We have these politicians that are in office. We have the Federal Central Bank, which he can't stand. And so the market's going to go down. And here's the sad reality about Steve. Steve's going to be right.
Eventually.
He's going to be right. I guarantee it. I guarantee Steve will be right. But you know what? Steve's not going to have any money.
No.
And what's more important, being right or having money? Trade with what you see.
Exactly. You know our brother Mark. He has that friend Bob.
Yeah, I know Bob.
And Bob's dad.
Yeah.
Bob's dad bought put options on the NASDAQ in 1999. And they expired 1 month before the crash. And what he did is he over-leveraged his account into these options. And so he was right, but his timing was wrong.
It's a story we've seen a million times, isn't it?
Seen and heard.
And it's the sad sob stories of the market.
Exactly. Everybody's got their bad beat story. Everybody, has that. And it's just a testament to when you have an idea. It's like right now in the market, Matt. I know that this market is BS. I mean, it's been floated up here for 5.5 years. Of course it's not going to go up forever. But going out and playing put options just because I think it should go down.
Hey, George Soros has 750,000 put options right now.
Well, he also has
$18 billion. But.
Yeah, many more $1 billion.
It's like 11% of his entire portfolio. But no, I get what you're saying. And what I try to get people to do when they're knowledgeable is you don't have to guess the top. That's the sad part. You don't, and it's also the amazing part. You don't have to guess the top. You don't have to guess the bottom. Not as an individual investor, because as an individual investor, we are faster than George Soros. We are faster than the hedge funds. We are faster than the mutual funds and the institutions out there. We get to wait till the market breaks support level on weekly charts, and then it's go time. It's timing.
I think I'm going to like this podcast stuff, Matt.
It's pretty cool, isn't it?
It is fun. I hope people enjoy it. I know that I guarantee it's like anything. You'll look back at your first one, you'll be like, man, we sucked.
No, that was awesome.
And then well, no, I know, but like in 6 months
you got work
to
do. You got work to do.
Oh, don't throw it at me.
I'm just going to say, if people do not enjoy this podcast, the onus on that is
fault.
you.
Send me an email.
No, I'll replace you as host. I'll get your wife on here.
Well, she is smarter and brighter than me, so that's
fine.
That's
typical, though. Women are typically smarter, better looking than their male counterpart, and also better traders.
Well, I've heard that a lot, but I look around. I think men just say that to try to hit on women traders. No. Because I look around, I don't see very many women traders. Like, I hear what you said.
That's because they don't need to go promote the fact that they're a trader.
Sure, fair enough. Maybe they're just not bragging about it.
Some of the best traders I know are housewives.
Right. No, I'm not. You're taking me down the wrong path here.
No,
I'm going to back up.
I'm just trying to make up for the early painting of the brush of me saying every Texan's a farmer and every New Yorker's a lawyer and all the hippies are from San Francisco. So I'm just trying to get you in trouble with your wife.
We're from a small town, guys. We apologize in advance.
I don't.
We say some dumb things sometimes, but it's fun though. I'll tell you. What are you looking at this week, Matt? What's the one thing
on tap this week? Market's at resistance right now. S&P has been showing weakness. The Dow has been showing weakness at those levels of resistance for 3 months now. So I would be a little surprised if the market breaks out of resistance levels. They've just been anytime good news, bad news comes out, they sell at those levels. I mean, you look at the unemployment report on Friday, 6.3 should be a good number, right? I mean, it just should be a good number. And you would think the market would respond up, but because the market was at resistance, it actually went down. I will guarantee you if the market was at support and that same report came out, the market explodes up. I guarantee you. You know, so it's having a little hard time at the resistance levels. The Russell already in a short-term downtrend. Russell's probably the weakest of the four major indexes of, you know, the S&P, the Dow, the NASDAQ, and the Russell. So the Russell, I mean, you look at that Russell chart and right around, you know, that 200-day moving average, it's been hitting it quite a bit. If the Russell can break down out of that 200-day moving average, that's a battle zone for buyers and sellers. I mean, that's trench warfare, World War I. That's the French and Germans moving 6 inches, right? If that war zone of the 200-day moving average can be broken on the downside, I look for the Russell to go down significantly. So I'm looking at that. I'm short the Russell 2000 right now through put options. I'm short the NASDAQ because that's the second one itself. You know what? Apple 600 again, baby. Last year and a half, Apple finally got back up to 600, closed slightly above 600. I'd look for Apple to continue to move up outside of that. 3 earnings reports I'm looking at this week, specifically GMCR, Priceline, and the one I'm most looking forward to is Tesla. Look for GMCR to gap right around 10 points. The market expects it to gap 8 points. Priceline, the market expects it to gap 60 points. My personal one is 45 points. And Tesla, the market expects a 19-point gap. That's pretty accurate. However, I just have a feeling, right? And we shouldn't really trade a lot on feelings, emotions, and whatnot. But I have a feeling this is a make-or-break earnings report for Tesla. Tesla, it reminds me back in the day, a couple of years back, when Apple was, and I'm not saying Tesla's Apple, but I'm just saying it reminds me of that scenario. You remember where Apple had like 5 straight years of beating earnings?
Yeah.
I mean, they always beat earnings, and the one time they didn't, it started Apple's bearish downtrend, right?
Got killed.
Yeah, and so, you know, I'm looking at Tesla here. And
I'll give you a better example than that.
Go ahead.
It reminds me of some of the solar companies.
First Solar, another one. Yeah, that's a better one. And that had an amazing run from 04 to 07, 08. You know, got up to about 300. You know, it's currently, you know, right around $50 right now. But First Solar, I mean, it did get down into the $10 range.
It took a hit, yeah. Because you know, and good for Tesla. I know they make $100,000 cars and they're really exciting. But how many times have we seen stories like this, Matt, that eventually pop?
You know what? We have seen them, but I'll tell you right now, Elon Musk is he's a visionary, and he goes against the grain. He goes against the traditional model. He doesn't care what other people think, and he just builds what he's building. I mean, Tesla for 2 straight years now has blown every earnings season out of the water. Every expectation out of the water. Tesla paid off their debt, their government debt, years before they were supposed to. They showed a profitable company on a quarterly report years before they were expected. Just recently in their last earnings report, they were supposed to project somewhere around, you know, 2,000 high-end cars sold, and they sold 6,000. And now they're coming out with this model that's in the 35,000 range. They're building a $5 billion playpen in Arizona.
Wait, what is this?
Oh yeah, $5 billion. You haven't heard of this?
I've not heard of this. What is this?
Yeah, they're building a plant, a Tesla plant, $5 billion Tesla plant there in Arizona, and you know it's a company. Oh, and by the way, they're also into space shuttles to the moon. And they're also into these pods that will take you from LA to San Francisco in 20 minutes. They're above ground. You lay down in it, shoot you. They're looking at pods from LA to New York. Now I'm getting crazy, right? Now I'm getting crazy. That's the visionary aspect of it. But specifically Tesla, man, they're an up and comer. But I do believe this is a make or break earnings report for it. It's currently at a buyer zone on a weekly chart. You're right at a support level on a weekly chart. It's been a fairly well, I shouldn't say fairly, a very consistent trend on the weekly chart, higher highs, higher lows. And right at that buyer zone, it'll be interesting. If you see heavy volume buying into Tesla coming out of their earnings report, those massive amounts of short sellers are running for the hills. Institutions are going into it, and look for Tesla to get into the $300 range. Now, that $300 range real quick on Tesla. I have revised that. About 4 months ago, my target on Tesla was about 330. I have revised that a little lower. I'm thinking Tesla's into the $300 range.
So I got this news story. This is interesting. They're building a $5 billion battery factory in Arizona.
Yeah.
It looks like it's just outside of Tucson. Wow.
$5 billion with a B.
Yeah.
They're not the Fed. They can't say the T yet, but
right.
I mean, they're working for it.
From the article I'm reading, it's at azcentral.com. It's the biggest one in the world.
Yeah, it's massive. Yeah. It's massive.
Wow.
And so I'm big into it. I love Tesla. I love the car. The cars look awesome, man. They look absolutely awesome.
Have you ever seen one though? Like driving down the street? I've never.
I live
seen
in
one.
Utah. We don't have Teslas in Utah.
They don't buy Teslas here.
We don't allow Teslas in Utah.
Right.
Okay? We're still on the horse and buggy.
Right.
No.
Well, I think that the main thing I'm looking at more than anything else is I want to see some action. The market is being very resilient here near resistance. I think you're right with the Russell and NASDAQ. I think you could go off on that a little bit about why the more aggressive indexes are showing weakness in the pattern than, say, the conservative ones.
Well, let's talk about that for a second. Aggressive stocks, by the very nature, when the market is hot, will go up faster in relationship to the other indexes. For example, last year, the Dow went up about 26%, the S&P went up 30%, but the NASDAQ and Russell went up 38, 37% respectively.
Right.
They're just going to go up faster. They're growth stocks. But when the market starts to cycle back down, when the market gets a little fearful, you see a rush. You see a rush from aggressive type companies. You see a rush from small and mid cap companies to more safe haven stocks. And that's why over the last 4 weeks to 8 weeks, you're starting to see aggressive sectors get hit a little bit. You're starting to see defensive sectors like consumer staples and utilities perform very, very well. Energy is the best performing aggressive sector out there. So when we're talking about the sectors right now, we're talking about energy, consumer staples, which are food-based companies, and utilities. You're talking about three sectors that, regardless what the market or the economy does, you have to buy. You have to buy gas. You have to pay your utility bill. You have to put food on the table. And so these types of sectors, when they show a lot of strength in relationship to the market itself, that shows you that the market itself is actually fairly weak. And so now that we're seeing a lot of these growth companies, biotech companies, technology companies, small and mid-cap companies, they're all underperforming the rest of the marketplace because money is flowing from those aggressive type companies, those small and mid-cap companies, to more safe haven stocks like blue chip stocks, like the defensive sector stocks like utilities and consumer staples and energy. And so when we see this, it's just your standard sector rotation stuff, but it is a telltale sign for the market. It is absolutely a telltale sign for the market because the market right now is getting defensive.
Yeah, there's no question about it. And, I was going through, I teach a class every Monday, and I was going back through the S&P 500 charts for the last 5 years, even through all this Fed money printing and quantitative easing, all that Orwellian stuff we were talking about earlier. And there's every summer, Matt, there's been at least one period in the market, whether it was May, June, July, or August, it's all different, but every summer you had at least an 8 to 10% correction.
Well, let's talk about that for a second. There's an old adage in the market. We all know it. What is it?
Sell in May and go away.
Sell in May and go away. And some cliches in the market are true, and some cliches in the market are not. Now, whenever you see reversals in the market, whether it's in the summer months, winter months, macro, short-term, stock, doesn't matter. You always see there's one common denominator in reversals, and that is slowing momentum. It will always slow its momentum. And when you look specifically since the bottom of the market in 2009, so let's just look at 2010, 2011, 2012, and 2013. So when you're looking at those, and I'm looking at the S&P 500 now, the top of the market in the S&P 500 in 2010 was right around 12.15. Okay, from the month of April till June, mid-June, it went down about 200 points. Okay, 200 points on a 1220 index is right around what percentage? What is that, about 15?
Yeah, 16, 18, I think, yeah.
Okay, so that was the summer. Now, that one started in April, and I'm going to talk to you about that here in just 1 second, because the adage is sell in May and go away. But does everybody know the old adage of sell in May and go away? Yeah, well, traders, investors.
Traders,
yeah,
everybody
traders
does, yeah.
So instead of sell in May, it seems like every year is like a week earlier, right? Because somebody's trying to get ahead of the steam. Like, for example, energy prices are the highest in summer, right? And so just through the logic of it, you would think in the summer and fall, energy prices would go up as you start to see the prices go up and as you see the earnings report for those prices. But energy prices actually start going up from a seasonality perspective in February. Not in the summer, not in the fall, but in February, because of the old expectation of that's going to happen. So the market just prices it in. Well, in the summer of 2011, this was the big one. You had a top in the market of 1365 in the S&P 500. 4 months later, you had an absolute bottom in the market. It only happened one day, but you had a bottom in the market of 1075, and so that's about a 290-point clip on a 1365 index. That's about 20%.
Yeah, big move.
That's right in your correction type things. Now, in the summer of 2012, the market topped out at 1421. And by the way, the market topped out in April again. Last week April, first week May of 2011. The top in the market started to occur in 2012. Right about April, right at the beginning of April. That's when the top, it starts breaking down in May. Well, the top of the market in April of 2012 was 1420. It came to a bottom in April about 1270. So what is that? About a 150-point clip on a $1,400 index. So that's about what, 9%?
150 on 1400 is more like 11, I think. Yeah.
Okay. And then the last one was 2013, and this was just kind of a subtle retracement. But in through May and June and coming into July, you saw the retracement, and this one went from about 1670 down to about 1580. So about a 90-point clip on a $1,600 index. So that was like a 5-6%, right? But in every year since the subprime market crash, you have seen slowing momentum. Some summers you've seen it go like 15-16%, some 20, some 10, 9, some 5, 6. But in every summer since 2009, and it's just a small sample size, it's only 4 summers, but every one you've sold in May and you've went away. Some pretty big, some pretty not. The commonality in all that is right now we're starting to see the slowing momentum. And we started to see the slowing momentum in March and April, and now we're starting to see in terms of the NASDAQ, in terms of the Russell, these things are already retracing. I mean, from we topped out in March in the Russell, at about 1200, 1210. We're currently at 1120 in that. You're already down 80 points in the Russell. Okay, that's already, and the S&P hasn't even done it yet. The Dow hasn't even started it yet. The Russell's already down 8%. The NASDAQ is already down, not as much, but about 5% on the NASDAQ. But if the S&P starts to break down and starts to do that correction that a lot of people anticipate, I expect the Russell to get slaughtered.
Well, no, that's exactly what will happen. The NASDAQ, the Russell, I mean, you're seeing it in individual stocks. You look at Google, you look at Amazon, you look at Netflix. The aggressive areas of the market are getting hit hard. And when the markets correct and change and they roll over, it's those big name stocks, the ones that made you all the money going up, they're going to get hit hard coming down. And smart traders will jump on that. They'll take advantage of that.
Yes, they will. And that's why right now I'm short Russell. That's why. I mean,
there you go.
So, it doesn't take rocket scientists to figure it out. It just takes somebody pointing you in the right direction. So there's massive opportunity in the market, both up and down, guys. There really is. It's a matter. To me, there's a ton of different traders, ton of different trading styles. I don't think you have to be anything like somebody else. I think you have to be the best trader you can be, but you got to figure out who that is.
It's our first podcast, Matt. I don't even know how to end it. It's like weird. I
don't want to end it.
I know I don't either. I want to do another one like tomorrow.
This is the first of many. We're looking at doing this at least once or twice weekly. It's how many times have we been asked in the last 5 years about, hey, why don't you guys do a podcast? Why don't you guys do a podcast? Why don't you do? And it's just something. I mean, we've been busy. We're traders. We're teachers. We're mentors. We have multiple businesses. We've just been busy, but this is something that we're going to prioritize. Get the information out to the masses. That is our goal through this podcast, is to get the information out to the masses so that they can make decisions over their financial future, so that they can start to control their financial future, and in the same light, have some fun doing it, guys. I always tell people trading is a blast. Trading Forex is amazing, but just trading in general is so fun. Learning how to trade is so fun, and so we're going to try to make the podcast enjoyable. Obviously it's going to be heavy financial type stuff, but I'm sure we'll take it in many different avenues over the course of time, because the simple reality is, guys, it's our podcast.
Yeah, I'll do whatever I want. It's funny that you just made me think of something. You know how slow I am when it comes to new technology? Oh,
you're our old man. You take the iPad and start pounding it, trying to open it. It's exactly. Horrible. You're horrible.
It's 2014, and this is the first time I've done a podcast. I mean, they've been up and at 'em for a long time, and I feel like this is like a new thing. Yeah, I remember when I was in high school, and some of the kids in my high school started getting the internet. It was like 1995, 1996.
Yeah.
And the only thought I had was...
Al Gore had the internet in 1975. I'm just throwing it out there.
All right. Yeah. But you understand my point.
Yes.
I just kept thinking, why do I need the internet? I have my Nintendo and Bond 007.
That was a good game, though.
It was great.
That was a good game. Oh, wow.
That internet stuff looks boring.
Oh, yeah.
Where I should have been buying Yahoo stock and Microsoft. Yeah.
Well, we grew up in a very poor community. Both financially and mentally, right?
Intellectually.
Intellectually. They struggle at times, shall we say. I hope every one of them listen to this podcast and hear me say how intellectually challenged the people in my hometown are. Don't get me wrong, I love them. They're salt of the earth type people. I still don't know what that means, salt of the earth type people. We say alkali people here, but they're amazing people, blue collar people, hardworking people, just intellectually challenged individuals. And, I feel thankful that we had parents who were hardworking, blue collar, but taught us to think for ourselves.
Yeah, I agree, 100%. And I'll send it out on this, guys. Check us out next time. Hopefully you can just favorite us. I don't even know how that works. Somebody's going to have to explain it. Tweet it or email it to me or something.
These we'll figure it out one way or the other, guys.
Yeah.
We'll figure it out.
Explain it to me as we go, but I hope you enjoyed it. Matt, thanks for the conversation. That was awesome.
Yeah, and for those of you, hit us up on Twitter. Check us out on the website, tackletrading.com. If there's a stock you want us to analyze, if there's a topic you want us to analyze, if there's a movie you want me to review, because, in my spare time, I watch every movie. As a trader, you watch a lot of movies. Just hit us up on tackletrading.com. Hit us up on Twitter, and we'll see you next time, guys. 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 See you next time.
You've been listening to the Trading Justice Podcast. If you've enjoyed yourself and think that the conversations and topics we've covered are important, Help spread the word. Give us your feedback. 5 stars on iTunes, like us on Facebook, and follow us on Twitter. The Trading Justice podcast is proudly sponsored by TackleTrading.com. Get off the sidelines and get in the game.